Hello. Hello and welcome to this MoneyMagpie webinar on how to invest in inflationary times. I'm delighted to be joined firstly by Karina Hicks from the Royal Mint. Give us a wave, Karina.
Hi, guys.
Thank you. Now, the Royal Mint are our sponsors tonight, and we're very grateful to them because it's allowed us to offer this webinar for free. And we also have, all the way from New York, my friend Jim Osman, who is the founder and CEO of The Edge, which is a consultancy that analyzes growth, prospects, spin-offs, special situations and opportunities for activist investors. Say hello, Jim.
Hey, how are you? Good to be here.
There you are. And we also have, excitingly, Boaz Shoshan, who's a former IFA, former independent financial advisor turned investment commentator with South Bank Investment, which I like a lot. And Boaz also runs a beer-themed markets podcast called Booze, Booms and Busts. You really have to say that carefully. And a weekly live YouTube show where he discusses market events called South Bank Live. Say hello, Boaz.
Howdy, great to be here.
Nice to have you, Boaz, thank you. And of course, as always, we have the lovely Isabel Lawrence, who's my glamorous assistant, as always. She's one of the Money Magpies. Say hi, Izzy.
Hi, guys.
There she is. Now, Izzy will be taking notes. She'll be helping people in and out, and she'll also upload the recording of this session to moneymagpie.com so you can watch it again later. Now, as you know already, this webinar is going to look at where on earth you can put your money so that it will grow and outpace the staggeringly high inflation rate that we're already in. I mean, goodness knows, honestly, how high it's going to go. Already it's 7% in the USA. Apparently, again, I think that really the real rate is higher than that. It's 5.1% at this moment, apparently, in Britain. I think it's probably about double that, really, in real terms, but there we are, that's me. And I keep being asked where people can put their savings. Mostly they're asking about savings accounts. And for a few years now, I've been saying, well, not savings accounts. Really, it's simply, it is just not worth it. You are actually losing money if you have money in savings accounts. Have a little bit for just in case, you know, rainy day fund, but for investing, forget it. So I'm going to get the ball rolling with a few questions of my own, but feel free to butt in or just put a question in the chat box, put your hand up, whatever. Firstly, Karina, what about gold? Why is it so special? What's so special about gold? Excuse me.
That's okay. So, yeah, I mean, there are lots and lots of reasons that people choose to invest in gold, but I think it has been linked to inflation, and it has been considered by many as a hedge against inflation, and not just individual investors, but countries as well, actually, have looked to gold as I guess, a type of alternative currency, especially in those countries where the native currency is losing value. I think one of the biggest appeals of gold is the fact that it's a real tangible asset. And also, you know, if you look at the performance of gold over the long term, it is certainly tended to hold its value over the long term. And, you know, it's a very widely recognized asset. The gold market is absolutely huge, which makes it a very liquid asset, so it's very easy to buy and sell all over the world, really. So yeah, I mean, to be honest, it's been quite surprising, the performance of gold over the last few months. I'm sure you guys would agree with me, because as I said, traditionally gold and the performance of gold is kind of linked to inflation, and it does tend to perform well during times of high inflation. But it hasn't rallied as we expected over the last 6 months. And I think there's a number of factors potentially contributing to that. I think it potentially needs and is going through at the moment a period of consolidation after, you know, the huge increases in 2020. So there's still potential. You know, there's been lots of talk about whether the inflation at the moment is transitionary. Is it set to continue? And I think if it does continue, there is certainly potential for gold to go a bit further over the next coming months. But yes, it's still a very, very popular choice. And we're saying to Jasmine, actually, that for us at the Royal Mint, demand certainly hasn't dwindled, and it's actually we're just trying to keep up with demand. I can say quite honestly, since the very beginning of the pandemic, demand has just gone absolutely through the roof, and we're still trying to catch up, which is a positive thing for us at the moment.
That's a nice problem to have. Absolutely.
It is.
I mean, as you say, it doesn't really make sense because you're really busy, and other gold companies I know, because I've had press releases, are really, really busy.
Yeah.
And yet the gold price hasn't gone up. I mean, do you have an idea why it hasn't gone up yet? Because I'm assuming it will at some point.
As I said, we saw it back in 2004, 2005 as well, after the financial crisis. Gold went through a period of consolidation, and I think maybe it's doing that again. It needs to kind of find a new price point and then settle down a little bit before it kind of potentially, not saying that it will, of course, but before it kind of takes off again, maybe. Interest rates have gone up recently as well towards the end of the year, and there is often a link between rising interest rates and then people moving their money from gold into those assets that provide more of a yield. But yeah, as I said, there's still lots of huge drivers for gold. You know, we've still got lots of geopolitical issues going on at the moment. The various COVID variants are providing lots of uncertainty there in the market. And actually physical demand, as you alluded to then, Jasmine, is increasing in lots of areas. And India and China in particular, which are probably the two most important areas of gold consumption, are showing very positive signs for demand, which usually is a good indication of what's to come for gold.
Good point. Boaz, you're a big fan of gold and crypto, actually. What's your view on, let's say, to start off with, the gold market? Do you think now is a good time to buy because it's not as valuable as we would have expected it at this stage?
Well, as Karina was alluding to there, it has been interesting to watch gold over the last couple of years during the pandemic, where it does seem like gold should have everything going for it. And to begin with, during the pandemic, of course, it was a great time to be a gold investor. However, things have waned somewhat. A lot of people think that crypto is actually stealing some of gold's thunder, and that's become very popular. And I think there's certainly something to that. But I don't think it's something that will last a particularly long time. I don't think over a long period, something like crypto will overtake gold. And I say that as somebody who works full-time in crypto now. So as I am very much a fan of precious metals, but in terms of what I do for most of my time now, I work with a decentralized exchange in the Solana ecosystem called Orca, where we effectively facilitate decentralized trading of various assets within the Solana blockchain, which is a separate thing. But a lot of people think that crypto is going to it's going to disrupt gold in a really, really big way. And you see, the crypto guys and the gold guys and the silver guys all love to fight over it. It becomes very, very heated. And I don't think it needs to be that way at all. And I don't think people who are investing in gold need to fear crypto, the manner in which a lot of people do. You'll find that, if you go to the sort of extreme Bitcoin maximalist community, you'll find people saying that, Bitcoin is going to unlock the industrial properties of gold because everyone is going to sell their gold for Bitcoin. The gold price is going to collapse, and we'll all be dining with gold knives and forks because gold is so cheap, like the monarchs of old. I don't see that happening at all. I think crypto and gold, while with Bitcoin, for example, Satoshi was clearly inspired by a lot of gold's properties. He was very interested in its scarcity, but ultimately these are quite different things. And gold, as my friend John Butler likes to say, you have to go back to first principles and realize that gold is something that was not created by man. And crypto, however, is created by man. So they're simply fundamentally different things. And it's a bit like comparing maybe an eagle and an aircraft. They both occupy the sky, but they are simply not the same things. And they both can be very beautiful, very graceful, etc. But they're not the same things. And as a result, they actually complement each other quite well. I mean, I have a lot of thoughts on inflation and crypto specifically, but I think that's a question for maybe later on in the discussion, as we're keeping with precious metals for the moment.
Yeah, good point. And Jim, I'm going to move to you because you really work in the stock market area. So would you say that a really good hedge against inflation is to pick the right companies, the right funds?
Well, I think, I grew up on a diet of value stocks, and, I'm definitely not a macro man. I don't really care, to be honest, what happens on a macro front. You talk to me about CPI, talk about inflation. Okay, I get it. But specifically, over the long term, and if Buffett resonates with any of your listeners here, over the long term, buying good quality names at cheap prices pays off. It's as simple as that. And you could
value, is it? You're saying,
yeah, I mean, value is going to do, what we've seen over the last 3-4 months is a move from growth. Okay, you've seen stocks like all those flashy stocks like Peloton, it's an iPad on a bike, for goodness sake, fall 40-50%. You've seen some of these other high-tech growth stocks falling, the same. If you look down all that list, you look someone like Jim Cramer, who's a big, no Jim, but he's promoted a lot of these stocks that have fell, 50% more. And it's a fact that that's an inflation, right? And growth stocks do bad in inflation. What doesn't do bad over the longer term, like I say, is value stock. So you need to kind of think that, if you want to put your money somewhere over the longer term, that, these sort of stocks or vehicles, you can buy ETFs of value names as well. Or, you don't have to be a stock picker, which I am essentially, to pick good names out there to get wealth creation. But it's boring, right? Look, I've got a couple of slides here can tell you why it's boring, but investors frequently are dragged to what is interesting, right? You tell me gold, I say it's boring. You tell me crypto, it's outperformed gold last year. People want where the money is. But the golden rule, and I've been doing this thing for 30 years, the golden rule is do not chase the hot money. Okay, that's the golden rule of any sort of investing. Because by the time of the small guy, and we are the small guys essentially, get to it, it's gone. All right. Time someone tells you that Peloton is the best stock ever, that's the high. Time when someone says to you, get into gold now, I think we missed it. Right? I think you missed it. That's why it's not moving, because price information flow knows that everybody here knows that that gold is a good inflation hedge. Right? I get it. We all get it. So what drives that price even higher? Superinflation, hyperinflation, maybe. But as it stands, you kind of missed it, is my view. So obviously I'm naturally biased in this, and we recommend stocks to, the biggest guys in the world, really. But it's value. From a value point of view, your head should be getting around in what is the next phase of the world, really. And, I grew up in the UK, as you know, and I've been here for 6 years. But what has opened my eyes at being over here as opposed to over there, which, I consider, I love England and I love the UK, but it's very, very insulated in terms of technology, is what's going on in the world today. You're getting, if I said to you metaverse, people are going, well, what's that? Facebook changed its name to the Meta in the last few months, right? Why? Because he believes that that's where the next phase of the growth is, in the metaverse. Bill Gates said this is going to happen in 2 years. You got Nike buying a virtual sneaker company. It's not even real to you and me. So, these are visionary companies that you've seen active in that sort of space. You got NFTs. How many of these guys here know what an NFT is? You should be educating yourself on what is the value down the line. We're about to launch our own NFT collection. So, people should be thinking about buying the growth or buying what's down the line in the future. Okay, not just now, because some of this stuff is very old hat. Me, I'm an old guy, right? You say, I want to meet in person, I want to do that. Young people do not want to do this. They never want to meet you. They never want to pick up the phone. They want to do everything virtually. You've seen it when you go on websites. You can't even get the contact us page. You can't even get anyone on customer service anymore. That's why it's changing. So you kind of, and as a guy doing this for so long, if you make a good investment, you kind of got to see what's down the road. Right? Because that's what you invest in, what's down the road, not what was before. Everybody knows what's happened before. It's what is down the road. So that's kind of where I'm from.
So you're talking about, let's unpack a few of these NFTs, non-fungible tokens, which is type of, in the crypto verse, as it were, in type of cryptocurrencies. So that's something that you're thinking is to look at, and companies that are in the virtual world, in the metaverse.
Listen, I've been buying land in the virtual world, and there's it's not unreasonable to say, let's go and have a meeting in the virtual world, and let's put our goggles on, let's sit by the fire, right? That sounds way out there. I know it does, but that is happening right now. That is happening right now, and the value of land is going up. I sent you that link, right? You saw that link that I sent you. And that is what is going on. So, as a UK, you're very insulated, I believe, from this sort of stuff. But you can see the big visionary companies, the Facebook, the Nikes, the people like that who are buying into it, right? I'm not saying it's going to happen, but it's something to consider if you're investing for the future. You should be investing for the future, not looking in the rearview mirror.
So it sounds to me like, as always, we're always saying, diversify. In other words, spread your bets across all sorts of things. So we're already talking about a few of them: gold, cryptocurrency, NFTs, value stocks, as opposed to growth stocks. As we know, growth means companies and funds that could go right up very quickly, but value tends to be that they're good companies, but they're quite cheap because nobody's really interested in them. So it seems that we're, as you say, Jim, we're moving from everybody being interested in growth stocks to people doing more like Warren Buffett has always done, which is go for the cheap, the companies that are good but cheap at the moment. And
I think it's right. Look, I bought a growth stock today, last week, and I bought a few bit more today, and it was Netflix. I think it's at 20 times EBITDA. It's a great stock to own, right? I don't think there's all growth stocks are terrible, but it's there's some growth names that are becoming cheap. So, like I say, think of the forward-looking view of where the world's going. If growth's come off 40, 50%, surely there must be some interest in the wreckage of that. Same as SPACs, a lot of those are way below their price. It's interesting because they've got cheap. So, you've got to kind of forward.
Excuse me, you're saying these clever words. You need to explain. What's a SPAC?
Oh, I'm sorry. So a SPAC is like an IPO. An IPO is initial public offering, which brings a company to the market. So say like an Uber, they're going to offer you shares at a specific price, right? A SPAC is a dumbed down version of that, where they can come with even less financials and dump it onto you in the market. That's the difference, right? If you want me to dumb it down completely. So, you got, and then they were quite the fad last year, where everyone was buying these things and they were multiplying, 30, 40%, and now they've all crashed in a heap. So I'm a fan of looking in the wreckage of stuff to find good quality names where people are discarded. Because at the end of the day, what you got to remember, and here's a story for you, in 2008, where there was a massive crash across the whole global universe, you've got to remember, the last person out is a small investor, and he's the last person in at any high, any top. So when you feel like you're selling, you're probably getting out of the bottom somewhere, right? Because you can't take any pain anymore. And back in 2008, it was the front page of Barron's, and it said the small investors started selling. And I was waiting on these stocks, particularly UK ones. They were offering these stocks at literally the valuation's worth £1, and they're offering them at 70p. So, I wanted to bet the house on it, but my wife said no. But at the time, that's the story. So, and it was upwards from there. But that's what you've got to remember on these cyclical moves, where you are in the cycle, because everything moves in cycles. You're going to get very bullish at the top, and you're going to get very bearish at the bottom. It's then where you've got to have your contrarian thinking to say, well, you know what? It's not that bad. They're selling stocks at the wrong price. So that's what I want to get your mind thinking about in terms of investing, not going where you think everyone's going, because it's probably the wrong idea. You should be going where no one's going.
Nice idea. Boaz, Jim's covered pretty much everything in the last 5 minutes. Boaz, what do you feel about what Jim's saying? Because you, as you said, you're into the crypto, but you're also into gold. What do you think is what we, the small investors, how should we be thinking? Should we be looking for the next big thing, or should we have a bit of a mix of that and the traditional stuff like gold and silver, etc.?
Oh, certainly. I mean, you don't need to be totally in one camp or another, as Jim is, while being a value investor and yet still being interested in things like the metaverse. I would query the claim that you don't want to be where the hot money is, while at the same time being interested in something like the NFT space, where there has been an awful lot of hot money, I would say, over the last couple of years. NFTs are very interesting indeed, but it has seen a huge amount of speculative capital. I think for something like gold or for precious metals in general, I mean, gold and silver, I don't think that's where hot money is at all. And I think that's what makes it really very appealing. So there certainly is sort of the common knowledge game of, oh, well, gold's a good inflation hedge. And inflation's here, and everyone knows that everyone knows gold's a good inflation hedge, therefore it's already priced in kind of thing. I'm not really a believer in that, as that means gold's overvalued and it's going to go down. It's not where you're going to be able to see any returns in the future. I think gold should be treated very much as a form of insurance. It's not something you want to actually claim on. The gold price going up is generally a pretty good metric of misery. No offense, Karina, I don't mean to offend, but generally great big gold bull markets are not very nice times to be, the common man. So you should own some as insurance, or if you're a wingnut like me, you'll own lots of it, right? Because you think it's all going to go down or something. But I think gold, the fact that everyone thinks that, oh, gold, it's just this barbarous relic. It's pet rocks. Why would anyone own this? I think this only makes me more bullish on the long-term prospects for precious metals, because ultimately when people are just chasing growth, or they're chasing things in the metaverse, or if they're just really strong believer in things like cannabis stocks. Very interestingly, after the 2017 crypto bull market, you saw a lot of this capital that was in crypto then rotate into cannabis stocks. We saw something kind of similar to that actually not too long ago, way sort of in the middle of 2021. And as Jim was referring to with SPACs, special purpose acquisition companies, they're very, very hot, but then they blew over. So maybe there's something in the wreckage that we could find in there. When it comes to precious metals, I mean, you should have some just in your portfolio, in my view, simply as insurance. How much you have is depending on how much of a wingnut you are. But in general, the returns that you can achieve when things go a little awry are easily enough, I think, to justify an allocation in your portfolio.
Well, I would imagine, Karina, that you would agree with much of what Boaz has said. Do you?
Yeah, I think it comes back to what you said as well, Jasmine, about diversification. And I think that's absolutely key in any strong portfolio. And again, kind of reflecting what Boaz said there, gold is often seen as quite a useful diversifier, especially because it does tend to react differently to the more traditional investment types like stocks and shares. You're completely right, Boaz. Gold does rally when the world is suffering, unfortunately. But during those times, stocks and shares tend to suffer, not always, but tend to suffer as well. So it is good to have that mix of assets that perform differently. And yeah, I mean, there's been a lot of analysis about the amount of allocation that you should put towards gold within a portfolio. And I think generally the recommendation is around between 2 and 10%. And again, it's definitely serving that purpose as a type of insurance. So yeah, I agree.
Yeah, speaking of diversifying, Susan Morris has asked about gold and silver. Is gold losing out to silver? She makes the point that I think silver is used in electric vehicles and solar panels and so on. What do you think about that, Karina?
I wouldn't say losing out. I think for us at the Royal Mint, gold is still the majority of demand that we see coming from customers, but there's still a huge segment that do like silver. It's got many of the same qualities. Of course, it is valued because it's still a finite resource and it's got that intrinsic value of the metal, but it has got that significantly lower price point. So it does broaden the appeal for a wider range of customers. But silver can be more volatile than gold as well. So some people prefer that. They like the kind of excitement of being able to trade when the market is more favorable. But then other customers prefer to kind of keep their gold, as Boaz said, as a kind of insurance for the longer term. So there tends to be different motivations quite often between the alloys.
Yeah, Boaz, there have been all sorts of what sound like conspiracy theories about silver. It seems, the Reddit crowd keep talking about silver being held down. I don't know why or how. Do you have a view on that?
Yeah, you kind of got to. If you're into precious metals in a big way, you will encounter plenty of people have theories as to why they perform in certain ways. And there have been just in recent years. I mean, I remember in 2019, late 2019, there was it was when people were starting to get really afraid of COVID, but it was before all the lockdowns, obviously. And there was a very large fine paid by a certain Wall Street bank because of because they've been found guilty of rigging metals markets. And so there's plenty of this going around. There are lots of theories as to it. You can speak about it for hours, really, because there are all different ways of in which someone could do it, why they would want to do it, private actors, public actors. It is something that you find a lot. Recently you have seen the Wall Street silver crowd. But then at the same saying that silver is manipulated. What we need to do is buy lots and lots of physical metal. This is going to cause a massive run on the paper silver market and silver futures. And this is going to cause the greatest super spike in history. I hope it happens. I'm not holding my breath, but maybe they're right. The reason you own silver is different for everyone, but it does certainly attract somebody who's silver. People who are really into silver are generally very, very interesting people. They often have very alternative ways of looking at the world, which I have plenty of time for. But when it comes to manipulation of metals markets, it's a tricky question. There certainly have been plenty of people who've been prosecuted for, well, not prosecuted for it, they're not gone to jail, but there are plenty of banks who paid lots of fines for rigging metals markets. So maybe there is. And the question then becomes, well, is it strategic suppression or is it tactical? So is it just some traders trying to make a bit of money by doing things like banging the close, where you force the market down at the end of the day? So on a long price chart, it looks lower than it otherwise would be. But then you get things like people saying, the United States, they're trying to preserve the value of the dollar. So they're the Federal Reserve, because they do have they have the authority to use things like metal swaps. They are the ones that are holding the price down to make it look like the dollar isn't losing so much of its value. But there are all these theories. I'm not going to tie myself to any specific one, but they do make for a very exciting conversation if you ever have one.
They certainly do. Speaking of exciting conversation, put in your questions. This is a time when you can ask the experts anything you like. Judy has asked, yes, where is the best place to buy gold? Well, Judy, we are being sponsored tonight by the Royal Mint. So obviously, I need to give you over to Karina. Karina, tell us about the various ways that you can buy gold. Because you do have quite a few different ways to buy gold, don't you?
Yeah, I mean, I think I'm a little bit biased when it comes to the place to go to buy gold, but I can certainly talk about the different ways of buying and purchasing. So it really depends on your preferences, whether you, and a lot of people still do really value that tangible, physical aspect of gold. And I fully understand that. It's absolutely beautiful. It feels gorgeous to touch. Same with silver. It is really lovely to hold a gold coin or a gold bar or even silver in your hands, and lots of people still really enjoy that aspect of investing in precious metals. You can also, of course, if you do that, I have to say you have to be able to store and insure your products appropriately. Don't go telling your neighbours that you've just bought a lovely big gold bar from the Royal Mint. Some people do choose to store their products with us at the Royal Mint. So we've got our on-site vault. Or other people store them in different kind of vaults, security boxes, that type of thing. And then other people want the value of the precious metal, but they don't want to think about the storage and the insurance side of things. So they choose one of there are many digital programs. Ours is called Digigold there at the Royal Mint. And with Digigold, you can buy online. You don't have to purchase a set amount, so you don't have to invest the full cost of a gold coin or a gold bar. You can choose your own monetary value from as little as £25, and that is fully backed by physical bars, investment grade bars that are stored with us within our vault, and we literally allocate you a sliver of a gold bar depending on the amount that you've invested with us via your online account. So that's a really popular option too. And then, of course, you've got ETFs, which are extremely popular. We've got the Royal Mint's ETC listed on the London Stock Exchange too. So there are just many, many different ways. And a lot of it comes down to personal preference, although some are, of course, more cost effective than others too, which plays a big part.
Speaking of, Jim mentioned ETFs, and as we know, they're exchange traded funds. Remind me what ETC is. What is an ETC?
It's an exchange traded commodity.
And so, and there are other ETs. It was just at one point, it was just ETFs, and now we've got ET, all sorts of things. But essentially, they're like kind of index tracking funds, but there are companies in themselves. I mean, they're very simple products. It's not lots of people choosing stuff. It's generally run by computers.
Yeah, and our ETC just tracks the price of gold and allows you to buy as part of your broader portfolio.
And Boaz, with your former IFA hat on, I have, as I said at the beginning, I am regularly asked by people, where can I put my savings? In other words, where can I put the money that I currently have in a savings account into something that's relatively safe, but will give me a better return? I mean, do you have an answer to that? Because frankly, I don't have one.
Well, I think part of my answer would probably sound quite similar to why I'm no longer an IFA. I mean, ultimately, there are certain things. There are certain things that within the UK regulatory environment, it's really very hard to do. Ultimately, I would love to tell all of our listeners and our watchers today, you just need to go down the road to XYZ Bank, where they shall give you a savings account that pays you 6% per annum, and you can take your money out anytime. Sadly, however, that's not the case, and that's not an accident. That is by design. Central banks reducing interest rates are deliberately, they're trying to force the market to take on more risk. And you, as a private citizen, you are actually included in part of the market there. So while it's not explicit public policy that savers get screwed, it's never said that way. I mean, that is what it is. So there aren't easy answers, which is why webinars such as this exist, where we can discuss alternate means of keeping your savings. It is very, very hard to make any serious compound interest these days. What was it? I think Einstein said it was the eighth wonder of the world, I believe, compound interest, and you can't get it anymore. People have been denied from it, and you need to find other ways of doing that. So one of the interesting things there used to be kind of a way out of this with what was called structured products, which banks would create, and they'd use elaborate derivatives in order to be able to say, okay, you can get your money back in, say, 3 years, or if the FTSE does X amount during this time, you will get X%, and they could promise you that, they could guarantee that. One of the very interesting things I've seen since I stopped being a financial advisor was how effectively the structured products market has actually kind of died. There are very, very few financial, generally banks which would offer these things, and they don't do them anymore because it's so hard to do it, because the options market, which they were using to extract this return, has become so filled with people who are just seeking yield. So everyone is trying to earn interest. Everyone's reaching for yield, and they're using these options in order to do it. And it's become so crowded that the margins are so small that it no longer even makes sense for banks to offer these special structured products to customers. So it's getting harder and harder and harder. And you're going to have to take more and more risk if you want to make the kind of returns that you need in order to retire. And this is not a happy situation at all. And it's why a lot of people, if they knew that interest rates were being suppressed in this way and it's creating all of these problems, they'd probably be quite unhappy about it. But it's simply the way it is. Most people don't know that. And as a result, some people have some very unrealistic expectations of retirement.
So, I mean, essentially, it's, as I was thinking, basically, we are going to have to accept that we as individual investors are going to need to take more risk, which means also we're going to have to diversify more. We're going to have to spread our bets more to make sure that we kind of mitigate that risk. Would you say that's the case?
It's certainly a perfectly valid point. Some people say diversification is the last free lunch in finance. I think there's certainly something true to that. Though at the same time, when a crisis hits, diversification goes to 1. So depending on how bad the future may be, diversification may not actually save you. And you've seen recently, in terms of people making really high returns, is generally people who've concentrated their positions around a lot of things. So something, people who were long Bitcoin in 2019, in early 2019, or people who are long Bitcoin at the beginning of 2020. They managed to concentrate their wealth around that, and they made an enormous amount of money. And a lot of people have retired, and indeed from the crypto boom that followed it, in NFTs and things like that. You've seen plenty of people retire. So I think if you really know what you're doing, concentration is fine. So if you actually know 100% about a certain sector, you know everything about it, you're really bullish on it, by all means, concentrate your positions around it. However, if you are simply trying to preserve your capital over the long term, then by all means, diversify it, but make sure you know what you're diversifying into. So a lot of people will do things like buy, a passive ETF that just, that tracks a very large index, like say the Russell 2000 or something, or, the MSCI World Index. But when you actually look into that index, well, it should be diversified. It's the entire world. And yet you look into it and, you really just own a lot of Google, a lot of Amazon, a lot of Facebook. It all gets concentrated around very similar things. So if you're going to diversify, make sure, do the homework and make sure that you know everything that you're owning.
Jim, would you say that you're one that really concentrates in certain areas? It certainly sounds to me like there are a few areas that you're particularly interested in at the moment. I mean,
look, I'm a bit of an anomaly here, right? I'm a stock picker. I have 10 to 15 stocks at any one time. I never have savings. I've never had savings. I don't believe in savings. They're a waste of time. The money will charge you for your savings. So I don't see the basis in that. But again, I'm different. Look, if you're talking about ETFs, over time, over 10 years plus, the S&P would have returned you 10, 11% without you doing anything. Okay. And you're talking about compounding on that. It's a great return. What you got to wary of at the moment is, and Boaz highlighted this, but let me put some numbers to it, that the 27% rise in the S&P last year, 26% of that was in 7 stocks. So, you got to watch your exposure on some of this stuff, because you're buying Google, you're buying Amazon. Okay, look, I think Amazon's a great company. They could break up down the line. There's huge value and there's some stuff like that. But again, diversification, I'm not a fan. Like I say, I'm a stock picker, but diversification, you can get in index funds, you can get from, spreading your money over there. But, and here's the but of all of this. Whatever you invest, you've got to start with a risk. Whenever I look at investment, and I don't put small amounts into investments, but whatever I start with a risk. What is the risk? How much am I prepared to lose? And you should be looking at that every time you invest in anything. How much am I prepared to lose before you look at the upside? Because sadly, if you look at the whole Twitter, you look at social media, look at all this stuff that comes out, they tell you what the return is. Now, excuse my French, but it's just bullshit. No one can target returns or sell those to you. You can say a fund will target 15% returns a year. So you can target whatever you want. I don't care what you target. You can't guarantee that to me. So you've got to be super careful when you invest of, what you're prepared to lose. So you don't necessarily have to put on more risk to return. Of course, there's a balance, and we get it, right? We went to business school, but it's the end of the day, you need to look inside yourself and what you're prepared to lose. And if you're not prepared to lose anything, and if you can't take it, then keep the damn thing in the bank, right? Hold it. All right, because you won't lose anything. You'll lose the charges that stop you. Because, even last year or year before, March 2020, when the COVID hit, if you'd have looked at your pension plan, and I appreciate and I encourage people to do this over the year, but because they do it here pretty much every day, which they shouldn't. But if you'd have looked at on that day, your IRA, which is the equivalent of your pension plan over there, was down 40%. Now, when you got $2, $3, $4 million in a pension plan, it's down 40%. You look at that, you're puking in a bucket. So, you've got to be careful of your risk tolerance, because it will force you out of your investments, right? Today, I'm losing a lot of money on a few stocks, right? But am I bothered? No, because I know where I'm at. I know I can buy more and there's cash available. So, but plenty of people will be forced out because of their risk tolerance. So you need to start with a risk on where you're investing. And that's very, very important for any size investor, to start with the risk of their on how much they're prepared to lose on anything.
These are Warren Buffett principles, aren't they? I mean, just think about the downside. How much are you going to lose? And also think long term. Don't be spooked by this sort of.
Absolutely. And I've made money every single year on those sort of principles. You know, I don't particularly like Buffett, but you know what? Look at the guy. I mean, he's, you know, what's the richest man in the world? Okay, we get it, Elon and Bezos. But where's he made his money? Consistently betting on good companies over the long term. Okay, and you know the Berkshire Hathaway stock continues to go up. So you know you got to respect that from the guy. So, but you're absolutely right. You know, look to where you feel safe and you can minimize your risk. And if you can't take any risk, then don't invest. Stock picking isn't for everybody.
No.
Okay?
True.
It really isn't. So don't be blinded by your guy in the pub and he says, you know what, Jim, you should be buying Peloton because it's a great thing that's going on. Hey, it's an iPad with attached to a bike, for goodness sake. Do you know what I mean? That's why it collapsed in a heap. You know, you look at the market cap of these things and the revenue they make. Most of them make zero money. It's awful. And they've been sold to you as good growth stocks. So you've got to be super careful of that in respect of, you know, trading off your mates' tips and stuff. Look inside yourself and see what you've got in terms of money. Yeah, you can put a little bit of gold. Yeah, you can put a bit of crypto. I bought crypto a while ago as well. So, but it's how much you're prepared to lose on it. And that's a very important point because that will drive your emotion, will drive you in and out of investments, and it shouldn't.
No, it's absolutely. Well, I've got some lovely questions here. Is it James Barry has sent me a message. Interesting point. He was looking at the price of gold on the Royal Mail website, and he said there was a big spike in 2005, and wondered, Karina, if you can explain why that was.
Oh, that's a great question. I'm not sure if there is an exact pinpointed reason. I know that during that time, 2005 to 2008, commodities across the board started increasing after markets suffered quite a bit in the years leading up to it. I think probably 9/11 had a big impact in 2001. Took a while for markets to start to recover. I believe there were high levels of inflation at that time too, and generally there was a bit of a boom for gold between 2005 and 2008, if I remember correctly. So maybe not one specific reason, but probably a perfect storm of various reasons creating that rally. But yeah, commodities, I believe, across the board did increase during that period.
Interesting. And Ron Dool has sent in, something about crypto, saying, isn't crypto actually very volatile? He's saying one of the riskiest of investments. Haven't more people lost money through it than made anything? Boaz, what do you think about that?
Well, certainly incredibly speculative. It is the last wild frontier of investing. I like to say that if it were an actual physical market, like the old markets of old, you wouldn't want to go into the crypto market unless you were carrying a gun. There are plenty of bad actors out there, you know, but just like the old frontier, there is vast treasure awaiting those who are willing to brave it. So yes, very speculative indeed. As for the total number of people who've lost money or made money, I couldn't say. You know, when it comes to things like, you know, 2017, where, you know, it was Christmas time and all of my friends were asking me about crypto and Bitcoin, and you get this, you know, everyone, you wonder who is still out there waiting to buy if my friends are still, you know, are asking me about it, right? Where's the new money going to come that's going to push this further up? And, you know, ultimately that marks a, you know, very sort of speculative bubble top. And then we got this big crash, and it took several years to recover. And yet, you know, there is still this great promise in there. And as a result, we saw, you know, a huge rise in something like Bitcoin, even after, well, you know, after the crash of March 2020. So even those who had bought the very top in 2017, they bought Bitcoin at $20,000. It seemed ridiculous at the time. And, you know, myself included, who had lots of Bitcoin then, you know, it seemed ridiculous. And yet, you know, here we are today, and Bitcoin still double that. So certainly it's very, very risky, and especially when people start going into the altcoin space and then they go even further out into things like NFTs, as we've already mentioned, things get riskier and riskier, and it's more and more illiquid because every NFT generally is different from another one. So the market for it is just like, it's like one eBay item effectively. So it's not like a huge competitive market for it. So it's very, very risky. It's not like buying stock. But at the same time, one of the great attractions of crypto is that it's not like a stock. So I would say for something like Bitcoin, no, everyone will try and tell you what it is. You'll get plenty of people saying it's a tulip, it's a bubble, Ponzi, whatever. You know, the press has been saying the same things about it for years and years, and they've still been wrong. But at the same time, you'll find people on the complete other end of the spectrum that think it's the best thing since sliced bread times 10. And ultimately, the jury is very much still out on what this ultimately is. It is a new asset class, and that comes with its own risks, and it comes with its own promise. And so if you are entering into it, I mean, it's a very risky game, but you know, there's great treasure out there still.
Very good points. I agree. And by the way, I do a 1-hour training course in how to get into crypto. So if you're interested in that, take a look on moneymagpie.com/webinar. End of advertising. We've got some other really good questions here. Oh, Izzy, you've put a question, sensible question from Isabel, Money Magpie Isabel, which is say I have £100 in savings to put into investments. What percentage should I put? I'm going to start with you, Jim, because you'll have a different view, I'm sure, to Boaz. If you have somebody starting off with their investing, what percentage should be in stocks? What percentage should be in gold? What percentage in crypto, do you think?
Well, you know what? I think that, again, anything you should invest in, you should start with a risk. You know, if you're going to put in crypto, you know, I put in crypto. I was an early investor in crypto. You know, but it was so speculative. I was an early investor in Tesla. It was so speculative. You know, I got DMs on Twitter telling me, Jim, you look an idiot for what you do. And I had to take that, right? You know, I'm on record, I'm on the internet saying it, but it's, you know, you got to manage the risk of what you're investing in. Now, if you're prepared to lose that, and it's something like crypto, NFT, goes through any of these speculative stuff that may be the future or may not be the future. You know, and as regards to crypto, you know, Boaz would agree that there could be a handful of currencies which could be worth it, right? It could not just be Bitcoin. It could be all these ones, Bitcoin Cash, whatever it is, right? Cardano and all these other fancy ones. But at the end of the day, if you're not prepared to lose what you invest in that sort of high risk stuff, then don't do it. Okay, it's a very simple rule. Just don't do it. All right. But if you are prepared to do it, there's no reason why. And I say to people, you know, if you're, you know, regular people in the UK, they're very, very conservative, right? Over here, they're like, they rush it up and they rush it down. Okay. But UK people don't ever want to lose money. That's always the thing, right? Where can I put my money and I don't ever want to lose money? Well, you know what? In the bank. But even in the bank, they're going to take the money off you. So, you know, it's a risk reward basis. So in answer to your question, you know, why don't you put like, you know, 60, 70% in an ETF that tracks the index over time, you're getting 10%. If you've got a 10-year view, it's all right. Why not put, you know, 10% in crypto? Because you want that fun. You know, as humans, we are driven by emotion and crowd behavior and fear and greed. So if all your money's in the bank, when you're going down the pub on a Saturday night and they say, you know what, Jasmine, we're making a fortune from Bitcoin here. What have you done? You're sitting there going, actually nothing, right? You're going to be forced into it. So you kind of got to be careful of that emotionally driven investment community that everybody's making money. Everybody does not making money. I am losing a fortune today. Okay, I'll tell you that. So, you know, it's part of that, you know, emotion and crowd behavior and fear and greed, which are driven you. But if you've got a long-term view and you manage your risk over time, you know, you can be very successful in this game. It's just people will throw good stuff at you and say, you know what, you want 40% return? You better be in with us in Cardano, in Bitcoin, in whatever the other fad is at the moment, right? I'm not saying you won't, but you got to be careful on what you're prepared to lose. So if you want to break out basis, it's down to your risk tolerance.
Absolutely. Oh, that's so true. So true. And we've got another question from Matthew. Matthew says, interesting question here. Yes. How good an investment now is an innovative finance ISA? Which is, as you know, there are different types of ISAs, and an innovative finance ISA is one where you invest in something like maybe a peer-to-peer platform, one of these new, as they call it, fintech, financial technology companies. Boaz, do you have a view on that?
What you can do with ISAs is very interesting. The rules do seem to change chancellor to chancellor. Everyone wants to try something new that's going to, you know, help the kids buy a house or whatever. Innovative finance ones, when I was advising and when I was very much into the ISA sort of space, there were very few providers. Maybe that's changed a lot. I've not really followed it too much, but if you can find somewhere reliable that can earn you a fair amount of yield, then by all means take a look at it. But you always need to remember with things like peer-to-peer lending, I mean, there's a reason why the yield is higher. There is greater risk. So you should know that you should read into that properly before you commit any capital to it.
Very good. Yeah, exactly. I think I mean, I actually have an innovative ISA, innovative finance ISA, but that was back when peer-to-peer companies were quite big, but a lot of them have gone now. So I think there are fewer, as far as I can see, there are fewer companies now to invest in, which is a bit of a shame, but it'll probably pick up gradually. Now, Jim, you very sweetly have put together a couple of PowerPoint slides, and I'd like to see what you have to say. What have you got in your PowerPoint? Because I know you've done some work on this to give us some ideas of where we can put our money to beat inflation.
Well, I mean, not so much where you can put in money to beat inflation. I mean, what I've done, I mean, you know, I speak to, our general game is speak to institutional investors, right? These are the people you read about. These are the people who move stocks. These are the people who break up companies. That's our main business, right? But every now and then people say, look, check in, Jim. You know, you got some wild views here and there. We like you. Come and talk to our small investors, right? So I give them a download of what I think. And usually it's not what they think about markets, because markets are perceived to be very, very professional. And let me tell you, some of the most unprofessional places you'll find in stock markets, the way people deal and trade, and it's not that. And I kind of, I had a few slides which I'd done before for some small investors, and I thought, if you want me to share those, just to give you maybe a different perspective of the market, the way markets work. And I've done this for a long, long time, and I'm a big contrarian in terms of the way I think. But if you want me to share those, I'm more than happy to. Just a few minutes on those. You're muted, Jasmine.
Sorry about that. Give us a couple of minutes on what your top line thoughts on this. Okay,
so you want me to just on the slides? You want me to show the slides?
Yes, show the slides.
Okay, well let's just see if I can share my screen. I already do this before. Well, I have done it. I'm just joking.
Oh,
I do it all the time. I just never get it right.
By the way, I've had a message from Anju about, apparently the sound went for her. I don't know if it's gone for anyone else. And she said, can she get a copy, a recording of this? Yes, is the answer. Everybody can get a copy. We're going to put it up on MoneyMagpie in the next few days, and we'll send it out in the newsletter as well.
Can you see that screen?
Yes, we can see that. I can see that. Hope everybody can see that. What is the stock market? What people think happens?
I mean, exactly what people think happens. It's a market where buyers and sellers are all professionals. They all know what they're doing. That is so far from the truth. It's unbelievable, right? Anyone comes along, puts some money in the stock market, buys a stock because his mate told him down the pub, and he buys it and they sell it, and that's that, right? Look, there's plenty of smart people in there. I think it narrows down to about 20%, but that's what people think. It's a barometer of companies' performance. You think that because the stock price goes up, that the company's doing well. That's not necessarily true either. Stocks can go up for a variety of reasons and down for a variety of reasons. And the trick is to identify those stocks when they move. Is it by Mr. Market moving them around, or is it just, is something really up with the company? And supply and demand equal the price of security. Same sort of thing. More buyers and sellers. Why is Peloton? Why was it an 80 billion company with no revenue? Right? I don't get any of that. Right? I don't get any of these growth stocks really, and I never was puffed into them, to be honest. But people will be dragged into those, and that'll be on the basis of people are buying them. Right? Look, more buyers and sellers, the price goes up. The opposite happens; it goes down. Right? It's as simple as that. So what really happens? It's not full of professional people. It's no difference from gambling. If you put your money in the stock, there is no difference from gambling and investing. You're betting on an outcome to give you a return on your capital. That's gambling. Okay, very simply. No matter how you say it, it's gambling. Some guy would say, well, you know what? We look at the company. We do this. I've got 5 analysts that do this for me, right? We look at the company earnings. We look at the EBITDA. We look at the cash flows, and this is what we got. Guy down the horses will tell you, I've looked at the horse, I've looked at the jockey, I've looked at the form. Yeah, it's the same thing. All right, this is the same thing. So don't ever think that people are smarter in the stock market than gambling. And also the strangest of factors can influence stock prices. You might have saw some of the guys on today might have saw GME and AMC and all that crap. Those stocks are zero, right? They got no revenue. They're awful companies. They're driven by, you know, people buying them and selling them up and down for no apparent reason, right? That's my take on it. Okay, and there's a strong opinion in there as well. But this is really what happens. Just who am I? I've been doing this thing forever, too long really. There's my company. You can log on to the Forbes. I write for Forbes on the side as well. You can have a look at there. I've got kind of some views on some stocks as well. So that's that. You go on.
Well, I was just going to say that that on its own is good. Let's get back to the normal. Can you close that screen for me, because I don't know how to do it. You're good at that, I'm sure. Because I was wanting to just ask Boaz as well. Do you feel that there's I can't do it. We need to.
Hold on. Stop share. Here we go.
Oh, there you are. Well done. Because I wanted to ask Boaz, just because we're coming to the end of the hour, and you know, because Jim says, understandably, that basically the stock market is gambling, but long term, does the gambling element reduce if you're looking long term, longer term, like years? You're putting money in for years, or is it still basically gambling?
Well, I think the investment industry would certainly want you to think that it is a very rational market, and over the long term, everything evens out. The GMEs and the AMCs, as Jim alludes to, are momentary blips, and in the end, what you know, Buffett says, they're a set of scales, and you know, we're all, in the end, the market is giving you the accurate, you know, weight of these companies, the accurate price of these companies. It's a very philosophical question. I would say ultimately markets are very good at setting prices for things like you know, commodities. This is why capitalism has been a success. You know, we've got market economies, but stock markets, because they have the speculative gambling element, are slightly well, stock markets, or really any kind of speculative markets, you know, these can be very irrational, and they get even more irrational when actors like, you know, central banks, which have public backing, put their hand on the scales for a very long period of time. And this is what has been happening now for a very long period of time. Well, for most of my adult life, because I'm a millennial, and you know, I was at school during the financial crisis. So pretty much all my adult life, you've had central bankers who have had their hand on the scales. So I think markets would be a lot more rational if they hadn't done that. But as they are, you see these incredible boom busts, which seem to just get more aggressive all the time now.
Well, very good point. And that, in a way, that's kind of what Jim's talking about as well. And you mentioned commodities, because we've talked quite a bit about gold and silver, which are commodities, of course. And we've spoken to Karina about, you know, various ways that you can invest in them. But commodities generally, which I'm guessing are supposed to do well, I mean, they are supposed to do well in an inflationary time. Are there, I mean, I'm going to go back to you, Boaz, are there good ways that you can invest in commodities as an individual investor?
Certainly, though you won't be perceived as very politically correct, and you will be thrown out by your ESG friends who are saying, no, everything's got to be green. I am from Aberdeen, so I'm very biased here. I'm very pro oil, and I would say the oil industry is going to be a very, very good place to be an investor in the near future. I'm very bullish on oil, despite there being all manner of hatred directed at it these days. But as I say, I'm an Aberdonian, so looking at oil companies, this is something very good. Something that's a bit more sobering, I would say. Though high oil prices are very, they can be a very sobering environment if you're in the wrong place. Food price inflation is something that is very, very destabilizing. This is something that set off the Arab Spring, and that is something that is effectively happening again. And it's you're seeing this in various parts of the world. You certainly don't want it to happen in China, because that's where civil unrest can get really, really nasty. But you're seeing it again in plenty of less developed places. There are businesses in agriculture which can make a lot of money off that, and it's a very interesting place. You need to go look at some of the very large companies that can pay nice dividends and things like that. But yes, commodities, buying shares in high quality commodity producing companies, be they hard commodities or soft commodities, is a very good place to be during an inflationary environment, which we are now in.
And Jim, you are a value investor, as you've been saying. Are there any particular commodities funds, companies, or whatever that you think are good value at the moment?
I analysed all my holdings of the last 15 years and looked at where I made money and where I lost money. You could have done everything opposite when I developed or when I recommended commodity stocks. So I've been very bad at commodities and biotech because it doesn't suit my analysis. Okay, so I've stayed away from those from a long, long time. So because the trouble is, and I take nothing away from people promoting that stuff because I'm just not good at it, but the trouble is with macro stuff is, you know, very heavily commodity related stocks are related to the underlying, right? So, you know, if someone turns the taps on oil, someone turns the taps off on oil, or gold goes up, or, you know, whatever the commodity or underlying asset is, they would have a massive effect on the company. So, you know, you can get some sort of margin of safety with buying some of those stocks with, you know, not a huge amount, 100% exposure to the underlying, but you got to be a little bit careful. So no, I don't have any picks on commodities or biotechs. I'm the worst at it. In fact, if I do, please do the opposite. So so that's really what I want to say on that. But you know, like I say, if anything, if there's a takeaway today from me, from your viewers and listeners here, just invest what you can afford. And I know it's boring. Don't get swayed by too many fancy stories. Don't go chasing too many hot things, because you'll end up losing it, right? So, you know, just be careful with your money. That's all.
Well, Karina, back to you, really talking about investing sensibly, regularly. I'm guessing you have quite a few clients that just have a regular standing order investing in Digigold or maybe an ETF. Do you have that a lot?
Yeah, one of our most popular savings type products actually is one that we launched quite recently, Little Treasures, and that's proven extremely popular with parents and grandparents. And exactly as you said, Jasmine, they can set up a monthly standing order for however much they want, from as little as £25, and that's proven really, really popular. And they just leave it there then to mature over time and to hopefully increase in value. That's a really popular option.
I think it's a great point what Karina makes, that, you know, and one, again, a takeaway, sorry I didn't mention this, is dollar cost averaging. Okay, you can invest, you don't have to go, look, here's 10 grand, here's 20 grand, here's $1 million, you know, into one investment. You can put that each month. And, you know, if crypto goes down, you're investing, you know, I've got my son putting crypto in every month, right? He's like, Dad, it's going down. I'm like, don't worry. You know, so, you know, every month a little bit goes out and it goes into the account. So it's averaging the whole time. And that's a great strategy for a lot of people, because they don't see a huge loss and it doesn't affect their brains. And that's the biggest problem. They don't get too scared,
definitely.
Yeah. So that's a great dollar cost averaging, or pound cost averaging, whatever you call it over there, is a great strategy for people to put regular amounts of money in every month.
I agree. I think it's one of the best strategies. Just every month, set up a standing order. Standing orders are your friends. They're certainly my friends. Set up a standing order of several of them every month, small amount. It could be a tenner, could be 10, 25 quid, whatever, but it's regular, and you get the ups, you get the downs, and it sort of averages out. It's a great one. Now I've got one more question that I will put out, and then we have to go to the end, but this is from Susan King. Now, ETFs have been mentioned a few times today, and she says, where can you put where can you put money into ETFs that will track the index? You mean there are various indices. Boaz, what do you think?
Yeah, it depends on the index which you want to track, and you'll find that there are plenty of different companies that offer ETFs that you can use. Ultimately, with any ETF, I would say you need to make sure that you get the right currency exposure, because if you get an ETF that's denominated in dollars, for example, and you need to then exchange your pounds for dollars, you're then exposed to the manner in which dollar moves against the pound. So you want to make sure that the ETF is denominated in sterling. So you find, I think Wisdom Tree do loads of ETFs that are in sterling. So make sure that when you are purchasing shares in any ETF, then you need to make sure that it's in your local currency. So if you're in America, obviously you'd use dollars. If you're here, you can use pounds. If you're in Canada, you're going to use loonie, et cetera, et cetera. So I would start with that. Though, of course, ETFs, the whole reason why ETFs have taken off so much is because they're traded like shares. So you purchase an actual share in an ETF. or in the case of the Royal Mint ETC, it's an exchange traded commodity. These are it's units of gold that you're buying, selling, and people really like to do that in an exchange environment because you get a bit more liquidity that way. So you do need to do it through effectively a share dealing account. So there are all manner of brokers that you can get in the UK. They're no specific one is paying me, so I'm not going to specifically recommend one over the other, but you can get it through any pretty much, an ETF can be bought through pretty much any regular share brokerage in the UK.
Yes, there are some of the main ones in the UK would be AJ Bell, and Interactive Investor, Hargreaves Lansdown, Charles Stanley. We actually have an article on MoneyMagpie about in fund supermarkets, they're often called investment platforms, and we're going to do more on those because they are a good thing to pick one, join it. You're often paying maybe a monthly fee or a fee per trade, and they often have huge choice of funds to invest in. Well, thank you. We've come to past an hour, and so I want to say thank you so much to my wonderful experts, Karina Hicks of the Royal Mint, Boaz Shoshan from South Bank Investment, and Jim Osmond, CEO of The Edge in New York. And remember, nothing that has been said today should be construed as financial advice. It's information only, and you should speak to a financial advisor for tailored advice for your finances. This has been recorded. We will be uploading it to the MoneyMagpie website, and we'll put it in our newsletter. If you haven't signed up to our newsletter, do. It's fabulous. We have one on Tuesdays every week, and then there's also an investing newsletter that we have every other Saturday. And before I go, I want to remind you that I've got some actual investing webinars, tutorials coming up in the next few months. I'll send you an email with links to that and to the investing newsletter. So do sign up. But it's been lovely to have you. Thank you so much for coming, and do come to some more. Keep coming along because it's great to have you all. Thank you and good night.